aka VIP, Salon Series event. The vision of our Bay Area VIP is to build community, connections, and collaboration. And the whole idea is to get everyone engaged in the Bay Area, not just alums, but also parents, prospective parents, friends. And the idea is to just engage through intellectual discussions, debate, engage in mentorship, networking, and philanthropy. And as everyone knows, COVID-19 has really kept us under lockdown. And so we've created this Salon series to enable the continuation of our mission, but through a smaller form factor that brings together our community. And we're hoping to get more people engaged during this time period. So, open up whenever you have questions. That's the whole idea of this smaller form factor. This is why we're doing a Zoom-based format as opposed to a webinar format. So if you have questions or comments, please engage with us during this time period. First off, I want to thank a lot of the people that did respond to our call to action survey. We sent this out a while back, and this is a survey to ask people if you were interested in getting engaged, either moderating or speaking on a panel. I want to do a special thank you to Ashmit Siddhana, Sumadi Saran Stewart, Nikita Seth, George Jones, Surya Turaja, John Rowinger, Natalie Vasaias, Chi Di Du, and I know a bunch of you had registered for the call. So thank you guys very much for being involved and volunteering. We're looking forward to reaching out to you soon to get you guys involved. Just as a reminder, this event is recorded. So, don't say anything that you don't want posted. Be smart about it. We will clean it up if necessary, but we do want to make sure that the other community is able to see this event as well. For the chat function, introduce yourselves actually, like if you can, your name, the year you graduated, the company that you're currently with, and the role. That'll be fantastic just for everyone to know who else is on the call as well. There is a raise your hand function. So if you don't know where it is, it's a little palm out there. So just raise your hand if you have anything, and we will make sure we call on you and get and grab your attention and bring you into the conversation. And if you're not talking at any time, just make sure you're on mute so we don't get background noise. Really quickly, we're going to launch a poll. We want to just see where everyone's knowledge base stood in terms of venture capital and funding. Maida, could you help run our poll for us?
There you go.
Great, we'll give another couple of minutes for everyone to trickle in their answers.
There we go. There we go. Everyone has answered.
Awesome. You want to end the poll and share it for us?
Yes.
Awesome. Well, fantastic. It looks like we got a bunch of people interested in the topic. So about 65% of us are interested in the topic. 35% are looking to start a business, which is fantastic. We love to assist you and bring the community together to see what resources we could pull in together for everyone. And another 20% each have either founded a business or are interested in joining a business. That's fantastic. Hopefully, David and Ken, that helps in terms of a perspective of our audience base.
Yeah, it means we can pick on venture capitalists.
What? There's not enough of them. Okay.
You are in the minority here, Mr. Lane.
Okay.
All right. Well, today I have the great pleasure of introducing two distinguished guests, Ken Klein and David Lane. Ken is, oh, sorry, can you guys see my screen?
Yes.
Or did I lose it? Hold on. I lost it on my side. Sorry, give me 1 second. Technical difficulties on my end.
We can introduce ourselves if we want. Dave, why don't you go ahead?
Yeah.
Do that.
David, are you still?
I think he looks frozen. I think he lost his connection.
No, let's just go ahead.
Okay. So I'd like to introduce myself because David is having some AV issues, I guess. But I'm a BSEE from Viterbi in 1981. I then went to work for IBM, and a lot of people ask me, how did you get in the venture capital world? And it's actually kind of opaque in many ways. After undergraduate school, I went to work for IBM, selling mainframe computers and SNA networks, and these little things called PCs came online during that process, and they were quite painful because we didn't get paid much for them, but that's okay. I then went to Harvard to get my MBA, and when I was at Harvard when I graduated in 1987, I'd found out about venture capital. Clearly it was a small industry then, and I wanted to really try and combine my interest in technology with creating businesses and helping entrepreneurs. And so that's what I've been doing for over 30 years now. Started with Harvard's endowment. At that time, about $5 billion in capital were invested in the United States. The primary path for people to get into venture capital at that point was individuals who were operating executives, usually in the high-tech industry, 20 plus years successful, and either created venture capital firms or started or joined them. Very small industry. I went, as I mentioned, through Harvard's endowment. Harvard was one of the first to get directly into venture capital investments, and it was a very small industry at the time. And I'd be happy to talk to you more about it. Hardware was the biggest investment area. There was also biotech, a little bit of software, some medical devices, but really a very different environment. And I came up with a couple quotes that I think will be near and dear to Ken's heart in some ways. And I want to say, Ken and I have done a panel together before. He's a true pleasure, and I'm honored to be on this panel. But here's a couple quotes. The first is from the Harvard Business Review, an article from 1998. So quite a long time ago, over 20 years ago, that described venture capitalists' attitude at the time. Quote, "The myth is that venture capitalists invest in good people and good ideas. The reality is they invest in good industries." Second quote is from Don Valentine. He is a legend. He's no longer alive, but he's the founder of Sequoia Capital. And he's quoted as saying, I like investment opportunities that are addressing markets so big that even the management team can't get in its way. So you think about that and what's being communicated. At that point in time, capital was very scarce, which is different than what it is now. It was mainly invested in the United States, and technology was moving much more slowly, and it wasn't disrupting as many industries. Today, it's a very, very different world. So when I came into the industry, the number of investment professionals was in the hundreds. Today, there's over 1,000 venture capital firms, typically having 5 or 6 partners each. There's corporate venture capital firms, there's hedge funds, there's Fidelity and BlackRock, so public money managers who invest in the venture capital landscape. And in 2019, US venture-backed portfolio companies received 133 billion. So think about my 5 billion 30 years ago, 133 billion. In fact, globally, 257 billion of capital was raised. Very different world. But the US, which was by far and away, probably got 90+% in 1987. Today, the US venture capital market, 67% of the dollars worldwide, globally, are invested in the US, 61% of companies. California, where most of us probably are, 60% of the US capital goes to California. But yet California only has 35% of the startups. Software, as you might imagine, is the #1 area. Different industries are being disrupted, right? We hear about the digital transformation. We can discuss that later if it's of interest. But there's a lot of change that's occurring. Also, with all these different venture capital firms now, people are specializing. Venture capitalists are specializing, venture capital firms by stage, by geography, by industry. And so a lot of different things are occurring where people are becoming much more specialized as investors. Now, there's some things that are unique to venture capital, but there's a lot of things that are not. And so I've created recently a fund with a few other people. It's focused on pre-seed and seed stage companies. David, I don't know if you have that slide to share, but I'll briefly explain some of the different parts that investors think about, because I'm not a late stage investor, right? I have a small fund, but we work with a couple people. And David's going to bring up a slide that explains a little bit about sort of where the investment areas are. And you'll see, at least on my slide on the co-founders on the left-hand side, many times there's family and friends who contribute to them. And then those founders, co-founders, sort of get maybe early customers, build prototypes, depending if it's biotech, clearly they're not going to have a prototype. But if it's some sort of service that they're building on AWS, they'll get something up into the market pretty quickly, right? And that's the great thing that technology has done, is now founders can quickly demonstrate traction in the markets with a minimal investment. And so there's incubators, accelerators. You've probably heard of Y Combinator, 500 startups, et cetera, is sort of the next phase. And then, we can talk to Ken about these different phases because he's been through all of them. And investors, different investors get involved at different phases. Clearly, if you have a very large fund, a lot of capital, it's hard to get involved at the early stage because there's a lot of companies that aren't successful. And so my current company, my current investment firm, focuses on the very early stage. We focus on people with high character, and we'll discuss that a little bit further into the process. We also look for companies with deep intellectual property. So it means they probably have patents. We look for people that come from whatever industry segment they're in. And most of the entrepreneurs who we fund, they don't come directly to us unless we already know them. And we fund a lot of entrepreneurs that we've known in the past or invested in the past. But we look for entrepreneurs who've been referred into us. And so that's a little bit about what I do. It's a little bit about history and where things have been, where they're going. And the last thing I'll talk about in this area, in this section, is really what Andreessen Horowitz and other venture firms have focused the venture capital community on. It's really about founders. Remember, I had those quotes about we invest in large markets, and that was the mindset for an extended period of time. And it really changed maybe about 10 or so years ago, where now people are focused on finding founders, hopefully that not only can start a business, but can scale it, like Mark Zuckerberg or others. And so I think, Ken, maybe I'll turn it over to you to give us some of your insights. Maybe how did you get to be a founder, and really what's your story?
Yeah, I'll be brief because I know that David's got some lightning round questions for us. So my background is primarily with venture-backed startups. I've done 3 startups that actually sort of amounted to something, one from 0 to 120 million, followed by another startup that went from 0 to 25 million and sort of stalled out. So I have that experience. And then for those of you who have heard of the company by the name of Mercury Interactive, we grew from 0 to $1 billion, which was definitely a home run. I've done turnarounds from 200 to 400 million. In that case, was Wind River Systems. And then I've done another company in the system space from 20 to 200 million that kind of hit the wall at 200 million. So I have a mix of experiences of some, a couple of, I would say, successes, one clearly home run, a neutral, and one that just a crater in the ground. So I've probably learned more about from that one that didn't work out so well than from all the others, quite frankly. So I'm currently doing I guess it's my 5th company. And by the way, I've also served on about 16 boards, both public and private. So I've had a bird's eye view in terms of what I'll call the behavior of the venture capitalist. And I think there's a taxonomy to VC, as David alluded to. And so we should really talk about that. There's not one sort of type of VC. And so hopefully, you'll glean something from that. But now I'm actually have a VC to thank for introducing me to my co-founder. I've started an AI SaaS company. I'm on the board of a company by the name of Mobile Iron, and the chairman of that board is a venture capitalist who introduced me to one of his entrepreneurs in residence, a PhD, ex-Googler from the University of Michigan. So there you go. Not USC, but not so bad, I guess. At least it's not Notre Dame. And 2 of us have been working together to build a company in the talent risk management space. So that's kind of what I've been up to right now, in terms of sort of over the course of a 30-year career. And I'm happy I think we should kind of launch into some of the questions that we had, David, about maybe whether entrepreneurs are made or whether it's nature or nurture for entrepreneurs.
Well, yeah, I mean, like, you guys have both amazing experience, both on the investment side and also on the founding side, right? So, but the theme of this entire Salon series is VC versus founder. So I really want to kind of hone in on that kind of key point of like this conflict. Ken, you founded so many different businesses. You've seen so many different like dynamics associated with the investor side and the entrepreneur side. Where do you think most of these conflicts are really driven from?
Yeah, so first of all, I want to caveat all my comments relative to VCs that David Lane is accepted for my comments. Okay, so.
whoa.
Okay. I think he's trying to raise capital from me.
So I'm talking about venture capitalists. It has to do with their experiences that are outside of relationship with David. So no, on a serious note, the conflicts, I think, really fundamentally arise from a disconnect in terms of incentives. And there are many of these. So when you think about a founder, as founders, we put our mind, our body, and soul into one company, and we have time for little else. A venture capitalist, generally, they put dollars to work. Maybe there's a reputational stake they have. But they're into optimizing a portfolio. They're into one, it's into many versus, yes, they hope your company is the one. But at the end of the day, if it's not you, it's, the other guy or gal in their portfolio. And I think that's a big part of the disconnect. I think when you begin a relationship with a venture capitalist, there's going to be a negotiation. They're trying to get more for less. And of course, we're trying to sell more, sell less of the company for more. So from the very beginning, there's there's a disconnect in terms of incentives. And I think along the lines, there are stages of a company's growth where, you know, the expectations may be very different. And I've seen many examples of these where a founder doesn't want to sell. The VCs at the end of the, you know, end of the lifespan of their portfolio or their fund, and they want to sell, right? That's an example. I've seen other examples where VCs will basically say, we want to go to a different go-to-market model and sort of try to impose that on the founder. I had one example where I was actually, I'm not going to name names, but it was in an appliance business, which is a very high-touch sales cycle, and a particular VC, who shall be unnamed, wanted us to move to an inside sales model. Well, I can tell you that would have never worked. And every time I saw him or chatted with him on the phone, that would constantly come up. So trying to apply this pattern recognition, which was honestly really bad advice. And so I'm going to be provocative here and quote from a friend of mine who was an entrepreneur turned VC, and his quote, not mine, was that 70% of VCs cause damage, 20% are inert, and 10% add value. So his point is be very, very careful in terms of if you have a choice to select your VC, you know, think hard because it's a marriage. So with that, David, I'll turn it over to you.
Okay, bash the pinata, and I'm feeling like the pinata. Thank you very much, Ken. You know, part of it is you have to look at incentives, and venture capitalists go out and raise funds from institutional investors or wealthy individuals, et cetera. We sign contracts, they give us money. These investors, called limited partners, we have a fiduciary responsibility to them, period. Okay. And we sell these investors on, you know, a fund that's going to do X, Y, and Z. And so that's what we have to do. Now, the reality is in any given portfolio, you're going to have 20, 30, somewhere number of portfolio companies. And we have a certain amount of capital. We place bets, if you'll say, on entrepreneurs. The risks that we take are market risk. Will the markets develop in the time frame that we think they should, or within our fund? Number one. Number two is technology risk for many of these deals, whether it's medtech or IT, et cetera. We're making bets that the entrepreneurs can build what they want at the beginning stages of a company, right? We have founder risk, management team. Can they build the team broadly? Can they build the management team? Can they execute flawlessly, right? Because you got to remember, in any given segment, it's not just one startup is going after it, especially with AWS and other infrastructures that lower the barrier to entry. You know, there's a lot of competition. I was talking to an entrepreneur the other day, and you know, what they're trying to do is being replicated around the world, right? And capital flows so quickly, and there's so much capital, and there's so many great ideas, and then there's a lot of entrepreneurs who can raise capital. So there's a lot of things that are changing very quickly. So we're taking all sorts of bets across the spectrum of portfolio. And then some companies are doing well, some aren't doing so well. And you think about what's happened in, you know, over the last 6 months, right? The last 4 months with COVID, it's made some companies accelerate quickly and others slow down dramatically. So I compare it to pistons. Some companies are going to be up, some are going to be down, but you hope at the end of the day, you know, when you're trying to exit companies, they're all high. But the reality is, as Ken was saying, entrepreneurs are very focused on making their company a success. You know, they bet all their chips on one number, and they hope that it works. And we do too, but it doesn't always work out that way. There's no conflict, or almost no conflict, between entrepreneurs and venture capitalists when the entrepreneurs achieve what they sold venture capitalists initially. It's like, yay, go do it. But the reality is a lot of times it takes more capital, it's longer, it's harder, there's people issues, there's just so many different things that go on that it's not a straight road. It is curving here and there and other places.
And so given that dynamic, David, like if you like, there ultimately is conflict when the outcomes don't align. So do you see stress and conflict at a, like right off the bat, or does it kind of progressively get worse over time? Like, how does that work in your mind?
It's a great question, David. I mean, a lot of it is when we invest in somebody, and I've had CEOs tell me this, they go, man, now I know what a psychologist going to that couch feels like. Because I'm trying to understand what makes them tick, right? What are their values, ethics, morals, vision of technology, vision of markets evolution, their network ability to bring in people, because we need to get alignment. Because if we don't have alignment up front on multiple different levels, we're never going to be successful as we go around that first curve. So the number one thing that I try and do is really understand people and share a lot of ideas back and forth. So it's not a shotgun marriage. To me, the best relationships are built on trust. Trust comes from, you know, being authentic, being transparent, having integrity, really leading, you know, being a servant leader in some ways where it's you're serving not only your company, you're serving your investors, your customers, right? It's a mindset. And when you look at where millennials want to work, over 70% want to work for companies that are missional, not just profitable. Profitable is important so you stay in business, right? But they're looking for missional companies that are trying to achieve something way beyond themselves. And my argument would be that if you create a high character culture environment, these people will stay longer than the traditional jumping from company A to B to C to D, right, over an extended period of time. So culture is important. A lot of entrepreneurs are young, younger than when I started in the industry. So they need more education in this area. I worked for IBM. IBM had a lot of training, part of which was culture indoctrination and things of that nature. A lot of young people come out of school, maybe they work for a startup and then they go and start a company. And they haven't had a lot of training. So this is where people who've been around for a while, like Ken, mentors a lot of young people, formally, informally. You know, I do the same thing. And it's really trying to tie into people who share a common vision of how a company should be run on one level, you know, on a human basis level. And then the second thing is, you know, here's the hill we're going to take as a business. This is the first hill, and you go over subsequent hills and eventually capture a mountain. And you need to be aligned when you start. And Ken, I'd be interested in your feedback on how you gain alignment. But for me, it's just a lot of discussion, and it's a shared view of what the future looks like. Yeah, and as long as you're talking in constant dialogue, you can evolve together and you can make decisions together. But if you don't talk, you don't engage the entrepreneurs, you just say, come and tell me how you've done in a year, you're going to get disconnected.
Yeah, so love to switch it over to Ken. Like, you know, how have you managed those conflicts, right? And at a certain point, you might need to break up with your VC, right? Like, and you characterize it like a marriage. So like before you respond, I want to throw a question out to the audience. So if anyone has any experience, you know, dealing with a hostile VC, I would love to hear that story if you're open to sharing with the rest of the group. But as you're thinking about how to respond, or maybe raise your hand, Ken, how did you manage your venture partners?
I think David has it right. I think that it's really important, just as VCs, the good ones at least, are due diligencing companies, founders, markets, et cetera. We as founders or entrepreneurs need to be due diligence venture capitalists. And I really believe it's down to the individual. I don't think you can pick, you know, a name brand VC and say, I'm going to do diligence that firm. You really need to get down to the partner level and really understand their behaviors based on history. And unfortunately, there's not a Yelp for VCs. I wish there were. I'm not sure it's a big enough market, but there isn't. So it really requires a lot of primary, secondary, in some cases tertiary research to reach out to other founders that have worked with that VC under different circumstances. I think it's really, really important to do that, particularly in cases, as David mentioned, where there's been a disconnect, where maybe growth stalled. I mean, the places where I've seen things go wrong, I mean, it really comes down to growth. VCs are expecting this, entrepreneurs do this, and that gap is what causes the tension. I mean, if the growth is exceeding the VC's expectation, or it's aligned, everybody's happy. It's when there's that mismatch in terms of expectations versus results where things go wrong. I think it's really important, as David mentioned, to have ongoing communications. By the way, just what I've found is that it's better to have small conversations frequently versus having just waiting for the board meeting to kind of lay something on your investors. I think it's really important to have sort of ongoing communications, constantly updating them in terms of what's working, what's not. I think is something that oftentimes is missed. So you do have to manage those relationships. One of the biggest mistakes I've seen founders or entrepreneurs make is go to their VCs for strategy. That's a recipe for a venture investor to say, it's time for a new CEO. If you're going to your venture investor and saying, you know what, I need your help to strategize, it's, you can have small conversations, but if you're going to a VC and actually asking them to sort of help you strategize, that's really a recipe for disaster, quite frankly.
So Ken, I don't necessarily agree with that. I think it depends on the stage of the company. If a company's very early stage, they're creating markets at the end of the day. And, I mean, fundamentally, I guess I agree with you on one level, but the thing I would say is it all depends how well your investor, your venture capitalist or angel investor, et cetera, knows a given market. Because if they're knowledgeable enough, they will help you go in different directions. The other thing is, I probably see maybe 100 business plans a month. I know what's going on in a lot of different markets. And so I'll take concepts from one market and try and apply them to other markets where my companies are. I'll look at partnerships that some other people may not look at. And so while I think you're saying, does a venture person have confidence in that individual or not? I actually look at venture capitalists being an allocator in many ways of resources, that they have a network. If they can't bring any, then they shouldn't be your investor.
Yeah, but David, I think you're, I think you're very unique in terms of that. And I think that my experience is that when I've been dealing with the investors I've seen, generally they tend to be great at pattern recognition.
Yeah.
And they try to apply these historical patterns to present circumstances, and that's very dangerous because markets have moved, technology has moved. So when they apply that or try to forcefully apply those patterns through an entrepreneur, disaster occurs. So what I'm saying is, as an entrepreneur, I think it's really important to listen to your VC, but you need to have the confidence to push back with facts.
Yeah.
And again, we have a relationship, you and I, where we could have that strategic conversation. I think in a lot of cases, VCs never get the time to get that comfortable because they have so many companies in their portfolio. They don't get comfortable enough with those founders, so they tend to look at a few data points and draw lines and planes and so forth. And so again, I stand by that comment that I think you can get yourself in trouble if you sort of are too vulnerable or reveal too much with a VC that you don't know well.
Yeah, but I think you said something that's really super critical. You speak to your investors broadly frequently, and it could even just be angel investors too. because at any point in time, you may want a favor, you may want to tap into their network, you may want their capital. And if they feel like the caboose, then you got to resell them again versus trying to have communications. Too many entrepreneurs, and especially in early stage, just sort of, oh, great, I closed on capital. I never reach out to my investors, right? And that's a huge mistake. You know, for any of you who are thinking about starting companies, you have to be connected to your ecosystem all the time, a big part of which is your investors, right? They bet on you. They'll bet on you again if they want.
And on the other hand, too many investors make promises to entrepreneurs that they never fulfill.
Yeah.
And again, you're accepted here. They promise.
No, it's true.
They promise customer relationships. They promise partner relationships. When it comes to the next round of funding, they just somehow go crickets and they're nowhere to be found. They don't make introductions to other investors. And so we as entrepreneurs spend months and months and months raising our next round of capital versus running our business. So again, back to there needs to be alignment and there needs to be proof of alignment through due diligence on both sides. Because again, some of our early customers at Presidio, David made that introduction, right? Met this, I mean, not to get into details, but met someone on a diving trip, introduced us, and it's going to be one of our, turned out to be one of our earliest customers. So you're unique, David. A lot of VCs make a lot of promises that they really don't actually follow through upon.
So I want to take a quick pause here. Sunil has a question. Sunil, you want to jump in here?
Yeah, thank you. Hi, my name is Sunil Ingle, and I'm an emerging founder. What I mean by that is I have a patent pending, and I'd like to see that go first and test the waters through the USPTO office before I go further with my venture. But I've been in Silicon Valley for some time, and I have attended numerous forums about venture capitalism, raising funds for your startups. One of the things that I notice, and it's actually something that keeps me awake at night. It should take anyone awake at night when you take money from people. So the source of money, it's very hard to do due diligence on venture capitalist or a venture capitalist firm, where the money coming from. Now there is, like other countries like Canada, even European Union, they do these things like if you're applying for investor visa or something like that, they say, this is the amount of money you need to have, and these are the list of investment firms or venture capitalists that is vetted by the government, and that there is no chance of money laundering or anything like that. So does US have something like that? Is there a list of firms or venture capitalists that is vetted by the government?
Yeah, so when venture capitalists raise money, we're asked that issue too. And so we have to go and ask our investors, help us understand from where your money comes. And so the money laundering and where your money comes from is incredibly important. And that list actually changes over time. There's not a published list that I'm aware of per se, but we have to go through and vet those investors. And that's actually a really good point because especially when you look at different countries, different organizations, we've got a federal government here, which is, saying bad government, good government, and then that changes by the hour almost. It makes it difficult. Money laundering is different though, as opposed to political, and there's better guidelines. But in looking at that, I would work with attorneys to make sure that you're on the right side of the law, because you don't want to start a company and worry about your investors. I mean, that could get you in trouble quickly. The other thing I want to comment though is when you started your comment that, or your comments in general, that you're waiting for the PTO office to give you a patent. You'll die an old man by the time you get there. And if you have a great idea and you personally believe in it, go for it. Patent or no patent. I mean, when I was starting in the business, we looked for patents, right? We thought they were important. And then we saw like some of these big tech companies try to squish, little startups. And if you have a lot of attorneys, they have a lot of attorneys. Startups don't have a lot of money for attorneys. And so patents are important for certain technologies, especially biotech, et cetera, but also maybe some AI and other things. But I wouldn't stop my starting a company just till you get the patents, because the patent office changed where now they want everything to go through and then people can litigate when there are issues. It used to be a lot harder to get patents. And if you truly believe in your opportunity, you should run quick, because some other smart guy like you is probably working on it in Boston. And that market opportunity will be gone. So keen insights that occur, time will kill them, because either they'll be proven not good or somebody else will capture it. So that's my encouragement to you.
The way I see the patent filing is it's more like the problem that I'm trying to solve that everyone experience, and obviously there's going to be parallel brains working on it. And so patent is one way to test, like, is this problem large enough that others are trying to solve? So I came across companies like Google, Facebook, Apple were trying to solve the same problem, but using different methods based on the data available to them. So that gives me confidence that yes, this is actually a problem that everyone's trying to solve, and it's just not me. So the other thing, getting a patent approved obviously takes time, but at least you know that you are in the company of people who are trying to solve the same problem. So you can align or disalign with those people, or try to.
Yeah, I think the bigger challenge is it's really going to be around product market fit and go to market fit. I mean, so that's where I'm with David on this. I think you should get into the market. I mean, get feedback from customers, because what you'll find is you'll probably have to iterate. What you thought was important may not be important. You may have to, it turns out maybe the piece that was patentable isn't really that valuable in terms of the context of the customer problem you're trying to solve. So I'm with David, get to market. There's lots of great books on this, the Lean Startup, MVP, I get out there and because ultimately it's can you solve a customer problem uniquely, and then can you figure out how to scale it in terms of the distribution. I think patents it's nice, but it's not sufficient.
Yeah, patents are particularly important if you want to sell to a Microsoft or Google, or on the mid-tech side, et cetera. They'll look for patents, and they actually believe they're of value, but that's not necessarily going to enable you to raise capital. People come to me and say, "Oh, we have these 4 patents. We've been working on this for 10 years, and we're thinking of now starting the company." It's like, man, the world changed dramatically in the last 10 years. So nice you have these patents, they're on your wall, they're framed, they're beautiful, stuff like that. But it's like that person has no sense of urgency. If they don't want to solve that problem today, they're not going to want to solve it in 5 years. And so anyway, I think this is an important theme that everybody needs to reflect on. If you want to start a company, or you want to join a younger company, make sure they want to solve a problem today, because we've seen that the best technology doesn't always win. That's been proven time and time again in our, in the technology world. Again, unless you're in biotech or some niches in the world, materials might be another area where that would be different. But in the vast majority of areas, which includes AI, you know, people can write algorithms in different way. It may not be pretty, it may not be perfect, but whoever solves the customer need first, they win, right?
Fast. Yeah.
Yeah, and they may put a bunch of open source software together that's not perfect, but over time, if they have customers and they make money, they'll be able to re-engineer and get something that's looking better and better. So that's
I would reorientate sort of the perspective, I think is what we're saying, toward solving the business problem. Focus on that versus the technology. There's a great book called The Mom Test, which is about basically interviewing. I really recommend it, which is it's a methodology for interviewing customers so that you don't create bias, understand what they go through, kind of a day in the life of a customer, what their challenges are, what their problems are, what they like about what they do, what they dislike what they do, what are they doing today, and figure out how to solve that first. Begin with solving their problem, then think about technology, then think about patents, right? So I would really reorder sort of how you're looking at this. David, I think you have some more questions for us, don't you?
Yeah, I got a few more questions. So in terms of you know, interviewing so let's do something more fun. Kicking out a partner. So how do you get rid of a VC if you've got a bad cap table? How do you get them out?
Oh, that's a good one for Ken.
So I have a story. The good news is I've served on enough boards so I can actually tell you the story. So I guess, you know, 16 boards, but we did have a situation where we had a board member, but he wasn't really, see, I'm already giving things away here. He was a board observer, not a member. So David will explain what an observer is versus a member. It's a small, slight difference. Wow. And we got wind that this observer was taking information from our board meeting and sharing it with the competitors. By the way, back to selecting a VC, you've got to be really clear about your non-negotiables. And one of my non-negotiables is I don't believe in investor promiscuity, which is investor and they'll claim that, oh, well, this company pivoted into your space or whatever, and if we hadn't funded it, someone else would. I'm really completely against VCs investing in multiple companies in the same market segment. But anyway, I digress. This particular advisor shared information. We couldn't prove it per se. We didn't administer a lie detector test, but we had good reason to, and eventually we gathered the other VCs and they basically conspired to remove him from our board. So I think it's really hard. I think that it's one of those things where when you take money from a VC, it really is it's literally a company long investment. It's really, unless you get to the point of, you know, a liquidity event like a sale of the company or an IPO, in which case, even then you may not lose that VC. Okay, I've had VCs and great VCs have stayed on well into a company going public, multiple years thereafter, honestly. So I think again, back to what David and I talked about at the very beginning here, which is diligence your VCs, just like they diligence you.
Great. We have a couple questions from the audience. Ali, you raised your hand. You want to go first?
Sure. Something very quickly for both of you guys. Beside knowing somebody who knows a VC, what is the next effective way of getting in front of them? And when you do, how do you approach them to get a time of a day from the VCs if you don't know them personally or you don't have a
that's a great question, Ali. And by the way, I think that's one of the worst thing about the system. It's VCs don't put up a shingle and say, we're Series A, we write checks for 3 million. We follow, we don't lead. They don't tell you that. They want to take that meeting and learn, right? Which means it wastes a bunch of your time and they get smarter. So it's not really set up as a very efficient process, which, by the way, I really wish someone would fix that. My experience is that you need to have a warm introduction. You just have to figure it out. You know, LinkedIn is a powerful tool. I think you have to know someone that can basically to make that introduction. I don't know how David feels about it, but VCs are really busy. I appreciate that. And they really bias toward warm introductions versus cold calls. I'm not sure, you know, I wish it weren't that way, but my experience is that's the way it works. I don't know, David, what are your thoughts?
I think it's suboptimal in many ways. The reality, when you think about it, is capital used to be the constraint, and those who managed the capital were the ones that were the gatekeepers. Now, that's much less of an issue than it is today, but it's still an issue. And, you know, the reality is not everybody should raise venture capital. So the first thing you need to do, Ali or others, is does your company have the profile that a venture capital firm would invest in? And that's, you know, looking at the market size, the growth rate, the competition, a lot of different things, right? And so it is one that you need to have the right profile of company. The second is we want to invest in people that are resourceful enough to get an introduction to us. Because if you're going to want customers to buy your stuff, whatever your stuff is, you know, your service, your product, we want you to be clever enough to find a way to get to that CTO or CEO or VP of engineering or VP of sales or whatever. We want to see people who use their networks to be effective, right? And it's a similar thing to get to venture capitalists. Now, the reality is if you have a startup, you have a good legal counsel, you have a good accountant, you have whomever that's tied into this network that I was describing earlier, the Silicon Valley network, which is really hard to access. And I'll tell you that corporations come here, they set up a venture group and say, you know, in the Silicon Valley, say, oh, we're going to be successful now and get all these cool deals and stuff like that. And they bring someone who has 2 years experience in the industry, and that might have been in a foreign country. And they expect them to even know where people hang out. I mean, I talk to corporations about this and it's like, they just don't really understand. So there are experienced service providers to the venture industry. You may be trying to work with have advisors in your company that are connected into the venture community. You may be working with maybe a marketing firm, depending on your business, or something else, who's well plugged into funding sources. So for me, if you're not able to access it, it's a lack of creativity. And I would put it back on you, right? That I want you to be able to find me in a way that at least I'll listen to. And I do want to listen to you. I want to listen to everybody. But as Ken said, if I'm going through 100 business plans a month, you know, I've got to move quick.
Right.
And so,
but there's some short circuits here, like the TIE group. Are you familiar with TIE?
yeah,
The Indus Entrepreneurs Group. There's Y Combinator. There are cheats, I would say, to get access to VCs. And again, advisors are great, lawyers are great, accountants are great, friends of friends are great, other entrepreneurs, right? You know, classmates from business school, from engineering school.
yeah.
You know, VIP here, this group right here. I mean,
Right.
David and I would be happy to make introductions for you guys, right? So, I mean, that's
Are
another
you sure about that? Okay, I take that as
And
Okay, well, see, it was
Ken would be happy to make all the
it was an
introductions.
hour well spent. So,
Yeah.
So we're coming up on time. We have a really quick 30 seconds. This you're not going to be able to respond to it, but very quickly, how can startups compete against big companies?
Easily.
Ben.
Easily. I work for IBM. You're talking about molasses. I mean, sorry, IBM, I guess, if this gets recorded. No, I think big companies, they have inertia that is just hard to get one going any quicker. And they're slow to to see opportunities. I mean, that's the great thing about startups is they can go out and actually find a market need much easier than a big company who has to do a marketing study. And, you know, you're creating new technologies. I'd much rather compete against a large company, at least have my companies compete against large companies than against other startups. Because the challenge is if there's other startups, one of the key factors then becomes who can raise the most amount of capital quickly enough, right? Like an Uber or Lyft. I mean, those guys just killed it from the amount of capital that they could raise, and then they blew everybody else out of the water.
But again, just since we have obviously some folks are just getting started here, let me answer it from an engineering perspective, which is pressure, force per unit area. It's really about narrowing the area, right, and creating pressure, right? So the more we only have so much force as a startup, we're small, but the narrower we can make that area, the higher the pressure. And that's, so I'm a huge believer in focus. Focus on a very specific problem that's not being addressed, that you can do in a unique way. Run the mom test, understand, what customers are, what their challenges are, and figure out from that problem area how to build a solution uniquely. And again, I think he or she that understands the customer problem the best is going to win, because big companies can't focus on everything at the same time, right? So I think it's really about pressure. As Andy Grove used to say, be a virus, right? I mean, I think if anything that we've learned from COVID-19 is very small things can have extraordinary impact, right? And so that's what I would say, in this case, be a virus in terms of driving positive change by creating a company that's actually going to be legendary someday.
Awesome.
Yeah, and I mean, the reality is a lot of established companies just don't see the opportunities. Because you have to either create new markets or you have to get there first. And when you're very focused, as Ken was saying, you can move so fast. A small group, in fact, even large companies, some of them have models where they'll just put 6-10 engineers focused on a problem, and they'll try and create a new product in that area because they realize the large development organizations have a hard time doing that. So I just think small teams have proven they can move mountains, and that's why startups succeed when large companies really struggle.
Well, with that, we're up on our 1 hour block of time for our Salon series. I want to thank you both, David and Ken, for participating and volunteering to speak today. And I want to thank everyone that came in and asked questions and got involved in our conversation. I really appreciate everyone spending their time today. Just as a quick note, if you can, get active. Maida will be, if you could copy a link out there and post it onto our chat, we would love to have some feedback in terms of how you guys felt about this event. With your feedback, we make iterations and changes to our series as well. Number two, if you're interested in speaking on a panel or volunteering, please contact Maida as well. Her email is listed on the screen here. I'd love to see and get you guys involved as well and do more of these events. And then also for our future events, please go to viterbischool.usc.edu/online event series, and you'll see a whole series of different online events that we're featuring at this time. Also, there's going to be a kind of like a mixer happy hour that we're putting on to have a different, like maybe a more engaged conversation about the same topic as well, most likely next week. So look out for an email following this. We'd love to see you guys again. And thank you guys all for joining us on this wonderful, less smoky afternoon. And please stay safe out there, everyone.
Yeah.
Thank you so much.
Thank you. Great questions.
Thanks, guys.